Today, we're going to start with the questions that we left off last week, and the assignment that we gave. Where is it? There we go. Prepare a mission statement. I hope you guys got to prepare it. I don't really need to see it, but your mission statement is what guides you. Your mission statement is what supports you. It's what tells your client, this is what I'm all about. So I tell you, on your mission statement, don't ever do it so fast that you can't fulfill what you're saying you're going to fulfill. So your mission statement is basically in a short statement saying, this is the service I offer, this is the quality, and basically you're telling them these are the ethics that supports my business.
Right.
I'm ethical, I will do a service next to none. Whatever that mission statement is, you learn to live by it. And whenever your employees or you hire new people into your organization, you make them memorize the mission statement. You know, what do we stand for? What do we do? Are we service orientated? Are we product orientated? Who are we? What do we do? What service do we provide? That should all be on your mission statement. I also said to prepare a first year marketing budget. I talked to you guys a few weeks ago about primary market and going into the primary market, doing your survey, doing your analysis, finding out what's out there. Do people want to buy your products? You know, I see as entrepreneurs, you guys brought smaller brownies. That's a good idea. Brownie bites. Again, you got to be creative. If you see that what you're doing is not working, something about an entrepreneur is you should never have shame. You should always be willing to change your name, to change products, to change. Never, ever feel that it's something shameful to shift. Myself, I've changed. I've had names in organizations left and right because change is a good thing. So whenever you feel that, look, I've been stagnant, I've been using the same thing, it's not working, be okay to shift. Be okay to do a change. And I always use the example that my professors used to use in the university, the example of cassette decks. For a long time, boombox were in. Boombox were it. You know, you carried a boombox to the park and press all the girls. But if you only got stuck on boombox, you're out of business right now.
Right.
Because I don't think nobody's running right now to Best Buy to buy a boombox. And nobody's running to Best Buy to buy a cassette deck. So what all these companies had to do, they had to innovate, and those products, though they were good, were left behind, and we go into new innovative ideas. So in order for you to prepare your marketing budget, you also have to do a secondary study. And last week we did some research on Dover, and we saw, you know, income, we saw population, we saw gender, 50% male, 50% female, population 17,000. Average income for a family of 4 was $64,000. But then we turned around and did the same secondary research for Bergen County. And Bergen County, what was it, like in the $300,000 for a family of 4?
Right.
So you start to see the vast difference. So if you're going to do business, this information becomes vital, because what you can do in Bergen County, maybe you can't do in Dover. So you got to ask yourself, what kind of business? Who's my clientele? What do I offer? Because if you go to a place like Bergen County, maybe things are going to change. You know, I usually have fun with real. Is that our phones? Oh, please, as you come in, mute yourself. All right, let me see if I can do this. As you guys come in, please mute yourself so it doesn't come through. I usually talk to real estate agents. Real estate agents come and tell me, I want to be a real estate agent. Well, you know that depending on the area where you sell, you have to get accustomed with that area. You know, if I'm a salesman in small houses, let's say like Patterson and Passaic, I might only be worried about, okay, well, this house got 4 bedrooms, maybe 2 baths and a basement and an attic. And for that market, that's all I need to know, because that's all we're selling. But now you go to Bergen County and they tell you, you know, I have a living room, I have a foyer, I have all these other different rooms in my house. You have to learn those names now. I have heated floors, I have heated driveway, so you have to learn based on the market that you're serving, because remember this, the market that you're serving has a certain level of expectation. So you can't go to a market that can support $500,000 with the same mentality and the same way that you work in a market that supports $100,000 property.
Right.
So again, you got to be willing to shift. You got to be willing to educate yourself. You got to be willing to learn. You got to be willing to ask. You get into the cleaning carpet business. You know, maybe the way you clean a carpet in a lower end area, less expensive area, is different than now you go to a house in Bergen County and they tell you, be careful, that little piece of rug that's only 12 by 12, that's a $25,000 rug. So now the products you might use to clean even the rug I'm in right now, and the products that you have to use to clean that specific rug because of the material that is made is totally different.
Yeah.
So I tell people, you have to know your market, you have to know who you're targeting, and then you have to get yourself educated. You got to make sure that I can meet expectations. What are the expectations of the market? What are they expecting me to provide? And again, with different standards, there's different requirements, and there's also different demands. So you have to know the demand of your market, and then get educated and know more than anybody else when it comes to your market if you want to be successful. So that was your assignment. Again, I'm not going to check it. That's up to you. If you did it, good. If you didn't do it, get it done, because it's only going to help you.
Yeah.
Well, today, we're going to talk about part 4 and part 5. I'm going to throw out a lot of information today. I want you to take notes. Then there's going to be a Q&A. Those that are online, make sure that you're putting your questions in the chat. We always get to those questions. Some of you, I will be meeting with you, because I know that some of you online have already submitted your request to the SBDC, and I've already been assigned to you. So I'm going to be calling you this week to see how we work it out. And we'll probably meet not next week, the following week, because I'm going on vacation next week. So it'll be a week in between. So I will be getting back to you guys with that. So today we're going to talk about management and operations, and your management and operations plan. You want to write that clearly. Review the components of a management and operations plan. Describe the pros and cons of different legal structures. Review the basic financial statements businesses use and the importance of bookkeeping for your business. Today, we're going to cover these 3 specific areas, because these 3 areas can break you or can make you. And not dedicating time on this up front will cost you at the end, at the tail end. So make sure you write those down. So today we want to identify key processes. Key processes are those processes that are vital for your business to succeed. What do I need that I know I cannot do without? Whether it rains, whether it storms, these are the processes that I have to function in order for my business to be successful. Develop a functional organizational chart. And the problem with most business owners is that they do not create an organizational chart. And if you don't do that, then where do you place your people? And what you usually end up getting is a boss that has their hands in everything, even the areas that they're not experts in. And that frustrates your team, and that eventually causes havoc within the organization. Create position descriptions. You can go to Indeed.com and you can look at those job descriptions in order for you to see what do I need, what I don't need. Is a great help to look at other job descriptions and then develop the job descriptions for the specific positions that your organization needs in order for you to function successfully in your business. And then evaluate skill sets needed. What are the skill sets that I need? Maybe I don't need everything. Maybe I have some of them. Myself, when I started my business, I was never worried about a bookkeeper because I'm an expert in that area. So that's not an area where I had to hire anybody, because I set up my own bookkeeping system, my whole accounting system, because that's what I do for a living. But when it came to law, I had to hire a lawyer. When it came to contracts, I had to hire a lawyer. When it came to sales, somebody being out on the street, when I was running my computer business, I could not be out there selling, so I hired a successful sales team. And then with the sales team, I hired a sales manager. And their job was to meet goals. My job was to do the big contracts with the big organizations, meeting with them, negotiating. My salespeople were the ones really in the front line, making sure that they presented to management, training, whatever was needed in order for my product to get out to the market. So I had a very, very strong sales team. So you have to ask yourself, what's the skill set that I need in order to succeed? The biggest mistake owners make is thinking they're saving money by doing everything themselves. That is a misnomer. That is a mistake. It's like the person that says, you know what, I'm going to do my own ceramic tiles. Have you ever done ceramic tiles before? No, but I saw it in Home Depot and I think I could do it. Now you do it, but it might look good to you. But now when you go to sell the house, somebody's looking like, wait a minute, how come you have 8 inches here and less than a half an inch over there? What happened? Well, you know, we started from this wall, it started going, we didn't measure the middle of the floor and went half and half, we just ran with it. Well, you just lost $20,000 in the sale of your house because somebody's thinking, I gotta rip that off. So I tell people, sometimes we're penny wise, dollar stupid. So what I tell people, hire the right people. Also, how much frustration? You know, like for example, I used to do that. I used to do that because I grew up around construction and I never had all the tools because that's not what I do for a living. So then I want to do my own tiles, but then I had to buy my own saw. Then I had to buy my own diamond blades. And then so by the time I finished buying the equipment, I could have paid somebody, it could have been done, and I could have been doing something else to make money. So where I thought I saved money, I lost money because you have to do in accounting, what is your time worth? That's the first thing you got to ask yourself. What is my time? How much am I worth? And don't be cheap with yourself. And ask yourself, you know, what am I worth? Am I worth 100,000 a year? Am I worth 150,000? You know, that's one question I love to ask when I do interviews. I ask those that come in, what are you worth? And they tell me, well, I think I'm worth 200,000. Really? What are you going to provide? And I start asking, because then I'm going to ask you the questions of a $200,000 employee, not a $25,000 employee. And then when you start asking those hard questions, it goes from 200,000 to 150 to 100 to about 80 to about 70 to about 60 to about 50. It's not what you want to make. It's what are you worth? What do you bring to the table that makes you valuable, that people would want to do business? And be brutally honest with yourself. And if you don't have the skill set, then get the skill set so that you make yourself valuable. And then look at the going rates. I tell people, go to Indeed, look at the going rates, because people sometimes throw numbers out there that are not realistic. So ask yourself, what are you worth? What do you have the skill sets needed? Daily operations and management components. This is the basics that a business usually needs. You usually need sales. Sales is everything. Can your product sell? Would I buy from you? Are you a go salesman? I told you all to do a 45-second pitch. Can you do that pitch? Can you sell yourself? Can you in 45 seconds tell me who you are, what you sell, and set up an appointment with me so that we can sit down and talk at a later date? See, some of you look like I'm testing you. I'm not going to test you now, but you got to know that. You got to be able to say who you are, what you're selling, what do you provide, what do you bring to the table, and can I set an appointment with you? Can I call you next week and we could talk about our business? Super important, super important. Sales. Number 2, administration. Administration is super, super important because without administration, everything crumbles. Who's making your appointments? Who's going to make the phone calls? If you provide a service with repairs, who's going to go and repair? You know, who's doing the bookkeeping? Who's doing HR for you? Who's going to make sure that you are within HR compliance and that you're doing what's legal for your employees? So who's part of your administration and team? Who's part of your accounting team? If you're in manufacturing, who's part of your manufacturing team? Then you got to figure out if you're selling a product, then I got to worry about delivery of service. Who's going to deliver for me? Am I going to do it through UPS? Am I going to do it through FedEx? Am I going to do it through another company? Am I going to do it through a private company? How much will it cost for me to provide delivery service? What's the cost associated with that? If I'm in development, how much do I need to invest every year into research and development? Research and development is super important because sometimes we get an idea, but if your idea is not selling, it's not a good idea. That's why you have to test the primary market before you start investing money. The problem with most entrepreneurs, the first mistake they make is they get excited, they get an idea, and they say, this is one good idea. I am going to sell my product. Oh man, I had a dream. And then you run with it, you haven't tested it, and then what happens? It starts to fail. When it starts to fail, you start to feel bad. And I don't want you to feel bad because business is trial and error. Even Thomas Jefferson said, man, I damaged millions of light bulbs before I finally got one to work. You got to get to that place in your mind of saying, I know that there's going to be a cost associated with research and development. I have to test the market. I have to test my product. I have to test the quality of my product. I have to test, can I keep it up? If I put a new product to market, how long before I introduce the next product? You know, do I have capacity? If somebody, what if scenarios? What if your brownies are so good that tomorrow somebody came in and said, I want to order 1,000, which I want to ship overseas. Can you supply that? Can you make that happen? And you got to ask yourself, do I have capacity? If I don't have capacity, how do I get capacity? So again, these are questions you got to ask yourselves. Because once you're in business, there's an expectation. And if you can't supply it, say from the get-go, I can't supply it, because the worst thing is to say I'm going to supply it and then not be able to supply it. Do you need warehousing? I tell people the accounting method that most people are ordering right now is on time. Ordering just on time. Why is that important? Because people don't want to store inventory. Because inventory can be costly. You know, you might buy a product today, even if it costs you $10, but if it stays too long in the warehouse, though you pay $10, it might go down to $8 or $7. So if you buy way too much, you can end up losing money. So I tell people the best thing to order is order right on time, preferably when you get the order, and always give yourself some leeway. You know, and if you stock very minimal, so there's never the risk of getting stuck with inventory. But do you need warehousing? Do you need customer service after you provide a service? Do you have the capacity for somebody to call and say, I didn't like your product. Your product was not what you promised. I want my money back. How are you going to deal with that? And that's usually the challenge with the small business owner, because the most small business owner, usually when you provide a service, you put the money in the bank, and most likely that money's gone, you know, the moment it hits the bank, because you're a small business owner. So what's going to be your policy for customer service? You know, can you give refunds? Are you giving yourself enough cushion to be able to take returns? You know, because imagine what happens in Christmas. You have big stores like Walmart. You have big stores like Target that they turn around during Christmas and they could do millions of dollars in sales. But then they have a line that says returns and allowances. Because I just made before December 31st, I just sold $10 million. But on January 1st, at least $3 million are coming back in returns. Yeah. So again, you got to ask yourself, what's going to be my return policy? Am I going to be okay? And then maintenance and repair. And that's the one area people don't calculate. Some people say to me, I'm going to become an Uber driver, sir, and I'm going to drive that Uber and I'm going to make a lot of money. That's great. Are you calculating maintenance? Are you calculating gas? Are you calculating insurance? Are you calculating the probability of a lawsuit? If you hit somebody and they're in the back of your car, or somebody hits you, you are going to get sued. Right. There is going to be a lawsuit because you're the Uber driver and it's your car. Do you have enough insurance to cover that? And again, these are the things that you got to analyze looking ahead. because most car owners don't even look at their liability. And liability, if the insurance says, for example, just to give you a little lesson on insurance, some people say, I got full coverage insurance. I'm covered. I got insurance. Well, if your maximum limits are $30,000, what that means is that the maximum liability that the insurance company is going to cover is $30,000. So you're like, man, why are you paying $500 a month? I only pay $100 a month. What are your limits? Because my limits are $300,000. What are yours? And why is that important? Because what happens with any insurance is they have a liability limit. And let's say the liability limit is $30,000, and you just said, I want to go cheap. I just want to pay a cheap payment. It's $50,000. Well, what happens is if you get into an accident and it's more than your liability limits, guess who's got to pay the rest? You. You do. So you had insurance, but it wasn't enough. So what happens? 10 years later, you put a boat in your parking lot or right there in your driveway. You went and bought a boat. There comes the government. There comes the sheriff and takes your boat away, takes your car away, because you are liable. So again, a business owner has to take into consideration every aspect of the business, and that's why you should sit with a lawyer and make sure that you protect yourself from personal liability. And we're going to talk a little bit about that today. So a functional organizational chart should look something like this. If you look over here on the top, you have the CEO. Who's the CEO? You are. Remember, you wanted that title? I'm the CEO. I'm the president. Well, you are. You're the guy at the top. That's all good. But then who's right under you? Right under you should be operations. Who's going to run your warehouse? Who's going to run your store? Who's going to run your facilities? Right across at the same level is your finance. Who's going to take care of your finances? Who's going to take care of your bookkeeping? Who's going to make sure you stay out of trouble with the IRS? And then on the other side, you have sales and marketing. Super important. So if you notice on this chart of accounts, these three are on the same line. And who controls that? The CEO, because all three are super important for that business to survive. Finance, operations, sales, and marketing. From there, as your business grows, well, finance starts to get kind of complicated, especially the bigger you get, the more complex the accounting. So now you need a bookkeeper. So now right under the finance manager, I got to put a bookkeeper that's going to work directly with the finance manager. But now my finance manager is also in charge of my supply chain, because supply chain becomes vital, especially when there's disruptions in the supply chain. So your finance has to be able to ship, because without supply, you're out of business. So this finance manager has to have a competent bookkeeper and has to have a competent supply manager, supply chain manager. Because right here is where the whole financial structure of the organization exists. Then you come over here and you have operations. Well, operations has to be very concerned with production. Are we meeting production? Do we have the supplies that come from the supply chain? So the operations manager has to work closely with the finance manager, because he has to make sure that there's enough supplies to keep production and keep workers working. Especially if we're working 2 shifts, 3 shifts, do I have enough material to keep everybody working and keep everybody producing? So I need a production manager that's staying connected over here and staying connected over here. And then I need distribution. Do I have the trucks? Do I have the employees? Do I have the methods established how my product is going to get out? Do I have a distribution chain? How is that going to happen? So that all works under operations manager. And then you got sales and marketing. And the sales and marketing, the first thing you got to, who's your outside sales? When you're in the office, who's out there selling for you? Who's out there promoting you? Who's out there causing a cause and effect in your business? Is your sales team. But then who's doing your advertising? You know, how are you marketing? Facebook, Instagram. Where are you advertising? And who's looking over the advertising to see the hits, to see the production, to see if it's good. And what happens with most business owners is that this guy tries to do all this. And then we wonder why the business fails. Because one thing is for sure, you can't do all this by yourself. So that's why you got to do a budget. You got to plan. You got to plan your finances. The first thing I told you, class number 1, is your personal budget. You do your personal budget, do that first. Where am I financially, personally? After that, you start developing your mission, your finances, everything else for the business, but also making sure that if you're working right now and you're making $60,000, $70,000, $100,000 a year, and you got to give that up in order to open your own business, then you got to ask yourself, how am I going to make up that money? Because you don't want to run a business at the cost of going bankrupt personally. Right. So you have to analyze your personal finances to make sure that I can sustain the business. And until the business takes off, maybe I got to live off my wife's income, or maybe I got to live off my husband's income, or maybe if you're young and living with, maybe I got to stay living with mom and dad a little bit longer until the business takes off. But your personal finances are critical when you're starting your business, super critical. So this is your functional organizational chart. So you start to develop one, even in your business plan, the bank is going to want to see what are your operations. And they want to see names attached to it. And banks get scared when it says CEO, Ed, finance, Ed, bookkeeper, Ed, supply chain, Ed, operations, Ed 2, production, Ed, distribution, Ed, outside sales, Ed, sales marketing, Ed, advertising, Ed. Who's going to run this? Ed. Who's going to do everything? Ed. Ed, if you get sick, who runs it? Ed. See what I'm saying? So you got to make sure you have a team, you build a team, and at least have initially starting a second person that can step up. And you can do a lot of these, but you're not going to be 100% efficient. And starting a business, it's all right. It's going to happen, but you can't stay in this too long. Right. Because before too long, you're doing the job of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 on average. That's why entrepreneurs burn out. So make sure you start thinking about your skill set. Who do you need? How can I succeed? How can I grow my business? Super, super important. Creating job descriptions. Related to the processes outlined in your functional organizational chart. Don't encompass more than one functional area. Be specific. Don't be structured to fit existing employees. One of the biggest mistakes that new employers do is that they try to accommodate their job description to the employee. This is your business. The employee has to adapt to your needs, not the other way around. So that's why it's important that before you hire your first person, you outline your organizational chart and you start to develop the functional areas that you know that you need, and that you develop a job description for people to fall into that job description instead of you adapting to the employee. Because if you adapt to the employee, you're never going to be successful. At this point of the game, you have to be able to tell that employee, this is what I need in order for my business to function, in order for my business to be successful. These are the requirements, these are the expectations. Very important. Be specific. If you're the owner of a business, I tell business owners, become friends with your employees, but not to the point that they disrespect you. You have to let your employee know you are the employee. You work for me. I pay you to produce a job. Right. And what happens in small business owners, especially, if you become too friendly, people start to slack off and people don't take you serious. You got to remember, I went to business on my own because I want to be a success. I am going to pay you a salary. I am going to take care of you. But in order for me to take care of you, the business has to produce. Because especially what I hear in statistics today, many young people come in and say, well, the boss is making money on me. Absolutely. Absolutely. If you work for me, I'm making money on you. If I were not making money on you, why would I hire you? Who would hire you to not make money on you? But when you get too close, People just see the gross amount. For example, somebody can turn around and see, well, wait a minute. My boss just made a contract for $100,000. He's got money. He's not paying me. Because they're not calculating, yeah, you did a contract for $100,000, but cost of goods sold are $50,000. So I'm down to 50. And then I got to pay the rent, and I got to pay the insurance, and I got to pay the utilities, and I got to pay the bills. From that 100,000, I went to 50. From 50, after I pay my employee and pay the bills and everything else, I'm down to 20. Yeah. Then I got to pay taxes. So now I'm down to 10. So everybody's thinking, and again, because employees don't understand, they look at gross. That's why I tell new employers, don't show your employees your contracts. Because if they don't know business, they're gonna think, oh, he just made 100,000 on you. Because all they're worried about is their paycheck, and they're going home, or to the check cashier, or to the bank, and they're gonna deposit their check. You gotta worry about taxes, quarterly taxes, sales taxes, insurances, building, rent, tools, equipment, because when something breaks down, what happens? The employee goes, hey, boss, it broke. Broken. Who's gonna fix it? You gotta fix it. So you gotta pull up the money. So I tell employers, always keep your finances confidential, because employees shouldn't be above other than finance and accounting. And you should always hold your people accountable to provide the service you've hired them to provide. I remember I used to walk my warehouse and I say, like my friend Dr. Rob Parsley says, I said, if you're leaning, you could be cleaning. So I would walk the warehouse, because I had a warehouse, and I would never let my employees just leaning, hanging around the wall. No, I don't pay you to hang. I pay you to work. Because if you don't work, you're stealing from me. That means that I might not be able to pay you because you're not making money for me. So I would always train them. Because if everybody's making money, everybody's making money. But if somebody's slacking, somebody's hurting. All right? So make sure that you develop a structure. Be specific. Don't be structured to fit existing employees. If they tell you, well, I can't do that, boss, maybe that's not the employee for you. Let me tell you the biggest mistakes we do. Hiring family.
Yeah.
Other than your wife or maybe your immediate children that can understand, be careful about hiring family. Big mistake. I would tell you right now, in every business that I've done consulting with, and there's family members involved, there's problems. Because somebody thinks somebody is cheating somebody. And the mentality of most families is, the CEO, he's making millions. Maybe you're not. Maybe they don't realize that you go home without getting paid because you paid everybody else. But in their mind, you're the CEO, you're ripping them off. You gotta be ripping them off. And then if you got a nice house and a nice car, oh my God, you're definitely ripping them off.
I paid for it.
So I paid for your house. So I tell people, it's not the case all the time, but be careful. Because it's easier to fire a stranger than to fire your brother or your sister-in-law. So make sure that before you even get started, you analyze your family relations. Once you have determined the skills necessary to perform the key functions of the business, you need to determine what type of staff you need to move forward. Who will do the work? Who's going to do the work? Will it be the owner? Will it be the employee? Will it be the advisor or board? Will it be outside resources? And I tell you, like Fiverr, I do a lot of marketing with them. I pay them one and out. I go to Fiverr.com, use them, they do my marketing, and it's done. It's very, very inexpensive. So you got to find where you're going to save money, what you can do to really function, succeed, to really run your business. So who's going to do what? That's the question. Who's going to do what? Operations and management summary, key processes, management, key advisors, staffing plan, risk and contingencies. And every business, you have to look at the risk associated with it. I have people that don't like to buy workman's compensation. They want to be cheap on insurance. you're never cheap on liability and workman's compensation in the state of New Jersey.
Right.
Because if you hire anybody or you tell anybody to do something for you and they get hurt in the process, they can sue you and be classified in a court of law that they were your employee, not self-employed. People think that because they don't withhold your taxes, automatically you're self-employed. That's not true. If they're working exclusively for you and you have authority at what time they come in and at what time they leave, and they're working only for you and they have not registered a business, they don't run a business, the only person they work for is you. They're not a 1099, they are an employee. And you have to pay their Social Security, their Medicare, and withhold their federal taxes and all their taxes. So you might say, no, I heard from a friend. Was that friend an accountant? Was that friend a CPA? Was that friend a lawyer? Because everybody hears from a friend. And maybe your friend's been doing it illegally for years. Talk to a CPA, talk to a lawyer. Because I've seen way too many people get into trouble considering somebody a 1099 and you're the only person they're working for. You control when they punch in. You control when they punch out. They're not a 1099. They are considered an employee by the federal and the state. You can get yourself in a lot of trouble doing that. Legal structure. Always choose a structure that fits both your business and personal needs. This is super, super, super important. Your structure can protect you. I tell people, don't ever run a business as a sole proprietor if you don't have to. And if you do, please make sure that you have enough liability insurance, that you have an umbrella policy, that you are covered. What happens with a sole proprietorship is the easiest of all the structures to create. You could go to your county clerk and say, hi, my name is Dr. Ed Ramirez, and I want to do business as ABC Cleaning. And they'll say, hey, the name is available. They'll give me a little certificate. I pay my $47 or whatever, and I walk out with my certificate and I'm ready to go into business. But I'm a sole proprietor. In other words, Dr. Ed Ramirez and ABC Cleaning are one and the same. So if somebody sues and my liability insurance is not enough, they will sue me directly and they have a right to come after my personal assets, not just the assets of the company. One of the safest structures to produce for small entrepreneurs would be a single LLC. What happens with an LLC? What happens with an LLC is if somebody decides to sue you, they cannot sue you personally. They can only sue up to the assets of the LLC. So let's say after all insurances, the insurance pays all the insurance is going to pay. If there's anything left, they can only take it from the LLC, not from your personal pocket. Same thing with incorporation. Some people might say, well, incorporation is double taxation. But incorporation, it is more expensive. Even in the state of New Jersey, if you have a corporation, you're going to pay about $750 a year, whether you had $50,000 in losses. That's just having a corporation in the state of New Jersey. You're going to pay $750 a year, even if your intake is zero. But it offers a total separation from the owners of the company. So an incorporation will file an 1120 or 1120S, meaning they even file an income tax return separate from the owners. An LLC, single LLC, will usually file a Schedule C. Though it is an LLC, that Schedule C is filed with your personal taxes. And it's taxed at your personal rate. So it all depends which way you want to go. You know, Inc. is total separation, it's its own entity. And even when you go for, be it for loans or be it you work for. In my case, if it's ABC Cleaning Inc., I can say I work for ABC Cleaning Inc. Incorporated is a separate entity from the owners. Offers, I believe, a total separation, total protection. There's no mixture, personal and business. On all structures, you should be keeping separate your personal from your business. Never ever run from the business your personal bills. The way you do it is you write yourself a check from the business, which will be included as part of payroll, which you cannot deduct when you're the owner, and keep that in a log of what you're drawing, so that at the end of the year, you will pay taxes for those draws. And you should pay every quarter. Every quarter you can pay that, and you sit with your CPA and figure that out. Partnerships, usually lawyers do partnerships. The problem with a partnership is that if one of the partners dies or one of the partners leaves the organization and it's just two partners, it's very difficult to keep it open when it's no longer a partnership. And you have to switch, and you got to get lawyers involved and everything else. So partnership is usually at least two. So S Corp is less taxes, but then it runs through your personal taxes in the form of what they call a K1. So these are just different structures. For a small business owner as yourself in this course, usually the best structure, and again, talk to a lawyer. This advice that we're giving is strictly, suggestive, not telling you what to do, because we're not your legal advisors, nor are we your accountants or your lawyers. But most small businesses will do a single LLC. It's the easiest structure to create, and it separates you, and it gives you some level of protection from your personal assets. So always have liability insurance, always have workman's compensation insurance, and if possible, always have an umbrella policy. An umbrella policy is a policy that after all other insurances are exhausted, that umbrella policy can be $1 million or $2 million, which is additional coverage over and above all the insurances that you have. So if somebody ever, God forbid, something catastrophic happened and your insurances were maxed out, you have an additional umbrella of $1 million or $2 million, and that insurance is not that expensive. So that protects you, is another layer of protection. Especially in a world where so many people are suing, structure is important. Employees are important. Skill sets are important. Getting informed is super important. So everything that I'm sharing with you is going to help you to progress. It's going to help you to grow. It's going to help you to set yourself up. Now we're going to go into accounting and bookkeeping for your business. This is super important. The first area of accounting that you have to look at is your balance sheet, your profit and loss statement, and statement of cash flows. These three statements are vital, are important. Many people like to go for loans, and then when you're asked, they're asking for you to provide them, hey, provide your balance sheet. Well, what is that? Provide your profit and loss statement. I don't know what that is. What is your cash flow? I don't know. I'm not an accountant. So today I'm going to give you a little review of why the balance sheet, profit and loss statement of cash flows are super important. If you want to succeed in business, you better know at least this level of accounting, because this is going to be a part of you. As long as you open a business, as long as you run a business, this will be central and a part of you for every year that you are in business. The balance sheet. The balance sheet is the equation. Assets equals liabilities plus equity, or assets minus liabilities equals owner's equity. I prefer to do it like that. Many accountants like assets equals liabilities plus equity. I prefer assets minus liabilities equals owner's equity. So we go back to the example I gave you in the beginning when we started this class. A lot of people don't understand the importance of getting rid of liabilities. So they go to buy a house, and because the realtor in the state says you could get an FH loan and only 3%, they're like, I got me a house with 3%. I tell people, pay more than 3% if you can, because then your liability is greater. So to me, it's like saying, okay, I buy a house for $100,000. The asset is $100,000. That's the value of the house. I paid $100,000. But because somebody told me that I can get away with super cheap, I'm only going to give $3,000 down. And now they're going to add the closing. And they're going to add all the expenses to that. So now you bought for $100,000 asset. But now I owe $110,000. Because they threw all the fees into that, because all I wanted to pay was 3%. So now you go to the bank. the bank is gonna say asset, 100,000, minus liability, 110,000. Equity, you're negative 10,000. I don't want to do business with you. You have no money. You are already broke. But wait a minute, I got a house. Yeah, but you owe more than what your house is worth. When what banks want to see is $100,000 house asset. I gave $20,000 down, 80,000. So 100 minus 80,000 equals 20,000. Okay, you got $20,000 of equity. Let's talk. I can give you up to 10,000 of your $20,000 equity. How can I help you? People will help you when you have equity. People will not help you when you're upside down. And the biggest mistake most people make is in their home purchase. So you got to be careful. Real estate is always good because it always goes up every year. It's usually a good investment, better and more stable than the stock market. But you have to ask yourself, how much am I giving down? Because some people think that what you're giving down is you're spending your money. No, you're reducing your liability. Right. In a real estate transaction, the more I give is money in the bank in reality because I'm gaining more of my equity. So this is important for you to understand. Assets minus liabilities equals owner's equity. And that's in every aspect of business because assets could be property, machinery, inventory, accounts receivable, anything that's going to bring value to the company is an asset. All that gets added. Probably for some of you right now, if you have a house, an asset would be your house. An asset would be your car. Your car is an asset, but it all depends because let's say you bought a car for 50,000, but you know, they tagged on the extra $5,000 now that they're tagging on to cars. So the car's worth 50,000, but I'm paying 55,000 because I'm paying a $5,000 premium. So in that car, I'm -5. So I need to pay that -5 as quickly as possible so that that car becomes an asset. So if I owe 50, I've already paid 10, you know, it's 40, I got 10. Or in the case if I've over, at least now I gain 5. So the quicker you pay your debt, the quicker you're going to gain equity. Equity is vital. Equity is important. Equity is what's going to help people to look at you as a business owner that knows what they're doing. So that's super important. So this is the accountant's equation. Assets, resources controlled by the enterprise as a result of past events and from which future economic benefits are expected to flow to the enterprise. For example, I buy a fleet of trucks. That truck is an asset. And that truck is going to produce money for me. If I'm in the delivery business, I just bought a truck that's worth 100,000. You know, I owe 80,000 on it, but that truck is going to produce for me 100,000 a year in transportation, warehousing, because that truck is going to be out there. That's a good risk because that. Make sure you mute yourself when you come in, please. So you got to make sure that you are always calculating. Is the asset going to produce money for you? Right? Liabilities, obligations arising from past transactions or events, the settlement of which may result in the transfer or use of assets. How does this work? Let's say I got in my checkbook right now $100,000, but I have something called accounts payable. Accounts payable are bills that come in. So I got me 100,000 in my checking account, and I'm like, man, my checking account look good. But now I got to pay the bills at the end of the month, which are my liabilities, accounts payable. But my liabilities are 90,000. So I'm going to take from the asset of 100,000. I'm going to pay my accounts payable, which is 90,000. So in reality, all I got left, cash flow, is 10. So it's very important that we always calculate our accounts payable and accounts receivable. So liabilities are super, super important for you to keep them under control. Because we covered in week 1 the importance of your credit. People are looking, how are you paying your bills? If you start to pay your bills late or you start to pay your bills slow, it's going to affect you negatively on your credit report. So it's very important that you pay your bills on time. I tell people as much as possible, before you go to business, save your money, build some equity, go to work an extra job, go into a business with already money in the bank. Don't go into business thinking that you're going to support yourself with credit cards or support yourself with just your savings account. Try to have leftover money so that you can take the risk, because business is a risk. And anybody that tells you business is not a risk, they're lying to you. It can be very beneficial, but it can also be a risk. That's why we're doing all these calculations, we're doing all this analysis, we're doing all this preparation, because we want to make sure that when we take that leap of faith, we take it in the best manner possible. We want to make sure that we are minimizing risk as much as possible. You want to minimize risk. You never jump without minimizing risk to the lowest amounts possible. Super important. Owner's equity is what you're worth. What you're worth. Anything that has value, anything tangible or intangible that has value. You got to make sure. You might have a patent, it's intangible, but that patent might be worth $50,000 or $50 million. So you got to know what equity do I have? What do I bring to the table? After you take my expenses away, what am I worth? Super important. Profit and loss statement. So let me explain this. So here I gave you, let me go back. The balance sheet. The balance sheet is separate from the profit and loss statement. It's separate and different from the profit and loss statement. The balance sheet consists of your assets. The balance sheet consists of your liabilities, and the balance sheet consists of your owner's equity. Those are three separate parts of the balance sheet. What you work on a day-by-day basis is on the statement of profit and loss. This is your everyday operation. This is money coming in, money going out, money coming in, money going out. And hopefully at the end, there's a net balance. So you have to understand your profit and loss statement. Sales minus cost equals profit. Simple. So when I sell a cupcake, let's say I sell a cupcake, it goes into sales revenue right off the get-go. I sold it for $10. My revenue is going to show, my profit is going to show right off the get-go, $10. It doesn't take into consideration cost or anything. It's just $10. It's what I sold it for. So I sold it for 10. On my profit statement, 10. I haven't deducted anything. At the end of the year now, I got to analyze what was the cost of goods sold. Okay, I sold that cupcake for 10, but for every cupcake, I spent $2. So cost of goods sold is $2. So I got $8. $8 is what I have. But the $8, I got to calculate then all my other expenses. Whatever is left over, then I got to calculate taxes. And after taxes, it's my net. Is what I'm left with. So it's super important that you always separate profit. Now, loss, though it says loss, is not really loss. What it's saying is income and expense. So loss doesn't mean by default loss. It means profit, income. Loss means just expenses. So you got to separate them on your financial statement. So you're going to have on the profit side, on the revenue side, you might have cupcakes, cookies, services, whatever generates income. One line for each one. And then at the end, that gets calculated. And based from everything I sold, from different things that I sold, gross revenue was 100,000. And then on the expense side, it has all the expenses. The first one is cost of goods sold. So what did the material cost me? That's number one. But then I got to have liability insurance, workman's compensation insurance, salaries, taxes, motor fleet, repairs, building, lights, rent, lease, snow cleanup, cutting of the grass, maintenance. So you got to have all those expenses that the business is going to incur. So you take every month, all the revenue that came in from every source, all the checks you signed to pay all your bills, and then you're going to end up with a balance, a gross net. Then you got to take from that net that you have, you got to deduct taxes, pay taxes on it. And then after you pay the taxes, you will have your net balance, and that's what you will transfer. Let's say I made 100,000, expenses were 50,000. I'm left with 50. I pay the government 10. I'm left with 40. Then at the end of the year, that 40 transfers over to the balance sheet into owner's equity. I made 40,000 this year was left over. So I have $40,000 of equity, which should be in your checkbook or in your accounts receivable. Then gross margins, which I already shared, that is revenues minus cost of goods sold, direct expenses equals gross profit, gross margin. Indirect expenses, sometimes called general and administrative expenses, are cost of running the business regardless of the level of sales. Example, rent. Rent doesn't care how much you sold this month, you're gonna pay the rent. Depreciation of your equipment, depreciation of your assets, they don't care how much you made this month, it's gonna depreciate every month, something. Your office salaries, your staff doesn't care whether you make money or not, all they know is Friday, I want a paycheck. Advertising, marketing, utilities, and supplies. Those are all examples of indirect expenses. Has nothing to do with you creating your product, but has everything to do with running your business. So it's important that you take into consideration your expenses and what you need to cover to make sure that you're calculating and you're pricing yourself right. Remember when I talked in the first week, pricing your items? Now you're starting to see why it's important that your pricing is correct. Because you can end up losing a lot of money if pricing is not correct. So you want to stay within market, but then instead price is not the only determining factor. You got to look at pricing, but you also got to look at service. Maybe I could charge a little bit more if my service is better.
Right.
So it's not always price. And never devalue. What did I say about 3 classes ago? Never devalue your price. Don't make that mistake. Because once you lower your price, people will not respect the value that you bring to the table. So if you're selling t-shirts, you're selling cars, don't devalue the price. Some people will buy from you, some people will not, but you cannot fluctuate in your price and devalue yourself. You cannot say this is worth $20 and I come and tell you I give you 15, and just because you want to do a sale, you just devalued yourself by $5. Don't do it. This is the price. You can pay it or not. I'll get a customer that will pay the price because my product is worth $20. You don't go to Mercedes-Benz, you don't go to Jaguar and just tell them, I know it says 100,000 on the sticker price, but I just want to give you 80. They'll tell you, thank you for your 80, get out of my shop. It has a value. So you got to know that your value cannot be diminished because someone doesn't want to pay it. And that's the wrong mentality. A lot of people try to lowball you. Don't let that happen. And then at the end, you'll end up with a net income or a net loss. Your accountant will help you. I tell you, get a bookkeeper, get a CPA, get somebody that's going to work with you, especially for you to know where I am and to determine your net loss or your net profit. Super important. Statement of cash flow covers a specific period of time, reports the cash generated and used during the period. Why is this important? One of the areas most people mess up in is accrual accounting. Accrual accounting is totally different from cash accounting. Accrual accounting is what the government respects, and it's the way you have to file when you do your profit and loss statement. What do I mean? I turn around and I have an accounts receivable. In other words, I give my clients something called an open account. I tell my clients, like your credit cards do to you. I tell my client, I tell you what, I'm going to give you a $50,000 credit line because you're a great paying, you're a great customer. So I'm going to let you buy from me on credit for $50,000. So what happens? Uncle Sam doesn't care whether you're going to get it, whether you got it, or whether you're going to get it. Uncle Sam just wants to know you made a $50,000 sale. So what's the entry? You're going to put accounts receivable because you didn't get the money. So you're going to debit accounts receivable 50,000. But that's not cash in your hand.
I can't hear the class.
Everything is stupid to you.
Please.
I can't hear it because you have the music on now. I can't get out of it.
You don't want to get out of it? So the music is stupid, you don't have to cut out of it? Pandora. Okay, I can bulk Pandora. Yeah, you never.
So what happens? You got accounts receivable. Okay, I got accounts receivable, 50,000. Uncle Sam says, okay, the debit goes to accounts receivable. You're gonna get the money sometime in the future. Hopefully they pay you. But you're gonna put right away on your income, 50,000. So as far as the government is concerned, you made a $50,000 sale. You're gonna pay me on the $50,000 sale. You're gonna pay me taxes on the $50,000 sale. But Uncle Sam, I didn't get it yet. But that's the way you run business. So the debit goes to accounts receivable, the credit goes to sales. So as far as your profit and loss is concerned, you made a $50,000 sale. That's not cash flow though. So what happens is, let's say I didn't have any expenses. So now at the end, I got a net profit of 50,000. But now the accountant or you come and say, what's my cash flow? If your bookkeeper just looks at the profit and loss statement, they will say, well, in income, it shows 50,000. But if you don't look at your balance sheet, you got an accounts receivable of 50,000. You don't have cash flow of 50,000 because that money has not come in. So why is cash flow important? Because what cash do I need to run my business? Right. So if I gave somebody a credit of 50,000, it's coming, but it's not here yet. But I gotta pay payroll of 20,000. Can I depend on that 50,000? No, I can't. I made a sale, but that's future money coming in because they haven't paid me. So I gotta make sure that when I do my cash flow, I check my checking account and I say, okay, checking account, what I really have in the checking account is 100,000, but I got $20,000 in expenses, 100 minus 20, okay, I got $80,000 cash flow. That's what I have. That 50,000 will come in the future. That does not fit into the cash flow equation because I don't have that cash. So what happens with most businesses? They don't calculate cash. So how much cash do you have in hand? It doesn't matter what you got coming in because you got to calculate in your mind as a business owner. My payroll every week is 10,000. So until this guy pays me from the 50,000, can I carry the $10,000 cost? Because my worker's not going to wait 4 weeks. Right. My worker wants payroll is every week, and every week it costs me $10,000. So I got to make sure that I'm fulfilling the need of my clients. So that is super important, super important. If you guys have any questions, write them down. You guys, we're going to do a Q&A later. And I know I'm throwing out a lot of stuff, but this is business. Yeah. Business. Now, projecting financial assumptions and projections. Determine how to make assumptions for your financial projections. Prepare projected financial statements. Develop the executive summary of your business plan. Learn tips on presenting your business idea. So now, the first thing we got to do is, how do we make projections? Projections is actually taking as much as possible actual cost. Look at your actual cost equation. It's super important. Try to evaluate as close as possible. Call the insurance company. Instead of guessing, what is the insurance going to cost me? How much is liability going to cost me? How much is workman's compensation going to cost me? How much are you going to charge me for bookkeeping services? How much are you going to charge me as a lawyer? And the more specific numbers you get, the better your projections. Because then you're going to know, okay, these are my expenses, and I'm pretty close in projection what I'm going to end up spending. And also on your revenue. And your revenue projected based on contracts, projected based on your, remember when we did our primary research? Based on that, I did some research. I can expect that this company has agreed to a $20,000 a year contract. So that's my first $20,000 coming in. From that $20,000, I figure out taxes and everything else. I tell every business owner, when you go to work for somebody and they give you a 1099 and they give you gross money, always put into a savings account at least 30%. 30%. And you might say, man, that's a lot of money. They want to do it 40%. So let's just stay at 30%. That's why people are so mad and small business owners, because they're not taxing the rich, they're taxing everybody. So it's important that you set aside 30%. If there's something left over, it's like income tax. You know, some people think income tax, you get money back. You don't get money back from income tax. All income tax is a reconciliation of the money they took out from your paycheck, and then they give you back what belongs to you anyway. People are like, I got me a refund. Uncle Sam gave me a refund. He didn't give you a refund. You just reconciled and you paid him too much, and whatever you pay too much, you're getting back. Other than when you qualify for earned income credit and all that other stuff. But for the most business owners, if you get a refund, you're just getting your own money back. It's not like the government is giving you any money, except for the stimulus and stuff like that during COVID, but that's something else. So projections of financial data should be based on the following: actual results, supportable data, or reasonableness. All three are super. The best is actual results. When I sit with as a consultant, I try to get you to get as close as possible. I analyze, I research with you, because I want to make sure our projections are as close as possible. And I always, even on the income, I like to project on the low side, and at the expense, I always project a little bit higher. Because at the end of the year, I'm hoping this is higher and this is low. So don't be over optimistic. I want you to really plan, and you can be successful. Business can make a lot of money, and if you want to make money, then work for yourself. Because if you're going to work for somebody else, you're always going to be limited. Remember, somebody's paying you whatever salary they're paying you because they believe in your skill set. So remember this: if an employer is paying you $50,000, $60,000, $100,000 a year, they're making money on you. $100,000 is what they're giving you, but you're worth a lot more than that because they're making money on you. So whatever they're paying you, they're making money on you. Maybe you can make it for yourself. Preparing sales projections, again, January, February, March, April, May. Again, on a 12-month calendar, you start looking. What are my projections? What's realistic? Who am I going to touch? How am I going to succeed? Who am I going to sell to? And this is a lot of hustling, a lot of working, a lot of projection, a lot of work. But it's good work because you're making money for yourself. Expense projections, same thing. Look at every expense, every possible expense. People sometimes like to be light on the expenses, and that's not good because they end up getting themselves in trouble. Okay, so let's take a 10-minute break. All right, class, we're back. Let's get ready for the second part of the class. So remember that cash is not profit. It's so important that you understand that there's gross cash. So just because you brought in 20,000, it does not mean that 20,000 is profitable, that you have to pay taxes on the 20,000. You only have to pay taxes on your net profit after you calculate all expenses. So that's super important to understand. So the first thing that you start when you start your business plan, you start with your executive summary. The executive summary is where you present your product to somebody else, your presentation, your business, what you're doing, why it's important. It is like a short paragraph giving in a few sentences who you are, what you're doing, and why would I want to do business with you. It is so important for you to be clear and concise in your executive summary. Presentation tips. When you present to a bank or you present to somebody, the first thing they're looking is confidence. Are you confident about what you're selling? Are you confident about what you're talking about? So I tell every entrepreneur, it's very important, get yourself in front of a mirror. Look at yourself, the way you present, and then ask yourself, would I buy from somebody that is presenting the way I'm presenting right now? Because we've all been confronted by salespeople. Some we've liked and we've bought from. Some we've said, I'm not buying from you. Your attitude, I don't like the attitude. I don't like the way you're selling. I don't like the way you're talking. I've done it in dealers. When I go to buy a new car, depends on the salesman. If they're too pushy and stuff, I just walk out. I'm like, I don't want to do business because you're not even listening to my need. You're just trying to sell me something. I usually like to do business with the one that asks me questions first. You know, one of the first indicators of a good salesman is that before they sell you anything, they ask you, what is your need? What are you looking for? Instead of saying, Whatever you need, I have it in the lot. I can service all your needs because that's a lie. But when you come across as helpful, remember that in order for people to buy from you, they have to trust you. There has to be a certain level of trust that you build with them. And of course, your ethics, be honest, be integral.
Right.
Don't oversell. Just because you want to do a sale, don't overpromise. Make sure that your ethics are never in play,
Right.
that you're being honest and you're being clear, and that you understand them and they understand you. Appearance, knowledge of your subject matter. You know, if you're going to go before a bank, dress appropriately. Don't show up with jeans and holes on them and flip-flops. Go presentable, go business-like. Show that, you know, there's a time to dress down, but there's a time in business where you got to look business.
Right.
Wear your business attire. You're going before a financial institution, make sure you're presentable. Look like a business owner. Knowledge of the audience, maintain eye contact, tone of voice, body language, engage your audience, visuals, use as an aid, not as a crutch. Too many people depend on their videos, and if all you do is talk about the video and not walk around and maintain a conversation and show that you know what you're talking about, that nobody knows your business better than you. Nobody knows your service better than you. Nobody can do this business better than you. You know the ins and the outs. You're confident. You give me a sense of assurance that me doing business with you is, I'm secure. I'm not going to get ripped off. I'm not going to be tripped over. You are the best person for me to do business with. So it's so important that your body language, you engage your audience, you keep eye contact, you're confident, you're able to answer questions. Because when you go before a bank, they're going to ask you questions. One of the questions they're going to ask you, how much money do you need? And what did I say you never say? How much do I qualify for? The moment you say that, you will be thrown out of that loan and you will not get the loan. What the bank wants to hear is, hi, sir, I'm applying for a $30,000 small business loan. The reason I need $30,000 is because I have to hire an administrative assistant, my marketing team, my lawyer, my accountant. Is going to cost me about $15,000 just to get that off the ground. I also have to do marketing. I've done research and I'm going to do marketing through these different agencies. That's going to cost me about $5,000. So it's about $20,000 just there. And then to set up the location and pay the lease and everything else, that's going to cost me about another $20,000. And then he's going to say, well, wait a minute, you're only applying for 30, but you just said you need about 50,000. Well, sir, I've saved $20,000. I'm putting my own money into my own business. I believe in what I'm doing. So I'm putting $20,000 of my own money, and all I need is 30,000. That's a home run, because they want to know, are you putting money into your own vision? If you don't finance your own vision, what makes you think somebody's going to want to finance you?
Come on.
It's the same thing with a house. People want to buy a house because they get with these real estate agents that don't know their head from their feet. And they're telling you, you know what, give as little down as possible, because all they're trying to do is make a sale.
Right.
A good real estate agent will tell you, look, I want you to get as much equity as possible. Down payment is actually money in savings. It's coming off the liability. So you're not in debt. You know, your closing costs and everything else, that's something else. But the liability itself, if you could get more money down, give more money down, because in 30 years, if you pay payment by payment and you borrow 150,000, you will end up paying 300,000. So I would tell you, if I'm your real estate, look, you can start with 30, but I'm going to tell you, double up every time you got extra money, double up, and let's, instead of 30, let's pay it in 20, so that you can save 100,000.
Yeah.
That's a good financial advisor. But somebody that tells you just make payments as little as possible, 3%, 2%, they're not thinking about you. They're just thinking about making a sale.
Right.
So that's the difference between a good financial advisor and one that is just looking to make a sale and keep you in debt. You come to me, I'm going to find a way to get you out of debt. We're going to pay that debt early. Well, that means I can't go to the mall. Good, you shouldn't go to the mall if you're opening your own business.
That's right.
That means I might not be able to go on vacation. Well, good, you don't need to go on vacation. You need to build your business so you can retire early.
That's right.
Yeah.
So I'm going to help you, but to own a business, there's hard decisions that have to be made. Some people only make their first $1,000 and right away they want a 1-week vacation. How much I made $1,000 sale. I've been stressed out. I need to take 2 weeks. So they made $1,000 to spend 3,000 and be 2,000 in debt. But I'm an entrepreneur. You're not an entrepreneur. You just got yourself in $2,000 in debt. If you're faint at heart, this is not the business to get into. But if you really want to build long-term success and build your wealth and not just be dependent on a salary, man, become your own boss. But your own boss means that you got to have the discipline you might have never had before. So that is super, super important. So this is as a final homework. You should prepare financial assumptions for your projections. As you prepare your business plan, start preparing assumptions, good assumptions. You might not have actual numbers, but sometimes it's good to ask and call for those numbers to be as close as possible so that your assumptions are as accurate as possible. Prepare a 12-month projected profit and loss and cash flow statements. Kind of prepare them. You know what? I think I could make net 30,000 my first year, 20,000, 10,000, whatever it is. Don't ever go into business. Some people go into business, they've never projected a penny. They're just jumping in by faith. And I tell you, have faith, but know your numbers. I tell people, have faith, but faith needs structure. You got to jump in and have a profit and loss statement, a projection in order for you. And then you got to be prepared when we meet, be it through Zoom or whatever. When you guys are ready, you can send me an email and say, I'm ready to present. You can practice with me. I'll give you a Zoom and you can present to me a 5-minute presentation of what you've come up with to see if you're ready. When I do my pitch event here, I want to be able to invite you back to compete and to be able to present your business plan. All right. So what is your business plan and your business plan presentation? So not only are you going to do projections, you did your mission statement, you're going to prepare financial projections, but now we start to prepare our final business plan presentation, and you want to be able to present your business plan before the class. Now, what I can do is, once you got your plan, and this is only if you want to present, you can present just to me. If you want to present to the class, I can send a Zoom to the class, set up a date, and that day I put you on camera, and you can present like you were presenting to a bank. And I will give you constructive criticism to help you strengthen your plan. If you don't want to do that, you don't text me. If you want to, then you shoot me an email and say, I want to present my business plan because I want a business plan that I can use when I go before a financial institution to make sure I can qualify for a loan. So I'm here to help you. So you're going to present that. So basically, that will complete your course. Is there any questions? What you do is, if you look at your presentation, one of the things I want you to look at is, look at your presentations, what you've done so far. The presentation is not that difficult. Some people freak out and say, oh my God, I don't want to present. If you look at the stuff that I sent you by email, I sent you already a business plan that's already developed. All you got to do is follow that same format and develop your own business plan. If you check it out, it's got a summary. It's got projections. Also, the SBA book that I gave you has a lot of information there. Why is this important? This is going to help you to develop your business plan where you can turn around and present that with your own numbers, your own calculations, your own research. Why is that important? Your research is yours. You know, it's like when people ask you, when you went for the doctorate degree, what? The research was mine. The reason I had to defend is because it's my research. Nobody should know that research better than me. So the defense is basically, I had to present my findings and I had to show that I'm the expert in the room pertaining to that particular information. You should be the expert when it comes to your business. Nobody should be better than you. Nobody should know more than you. You should know the ins and the outs. So in the executive summary, you'll put, this is what my business is all about. This is what I do. This is what I plan on doing. This is my target market. This is who I'm going to look to do business with. This is who I'm looking to target. This is who I'm looking. You got to be able to flow back and forth with your information. These are my financial projections. The bank is going to ask you, well, what do you project this is going to cost? Well, sir, I've done my analysis. Insurance is going to cost me this. Marketing is going to cost me this. Legal service is going to cost me this. The first level of employees is going to cost me this. I'm going to need an administrator. I'm going to need an accountant. What expertise do you bring to the table? Well, I bring to the table, I have a doctorate in business administration. I've been doing business for about 40 years. I bring to the table accounting. I bring to the table business projections, business analysis. I've worked as a consultant for 40 years. So this consulting business will have the expertise backed by my education and backed by my experience. Administrative wise, I will have an administrative assistant that will do coordination and planning. They will set up appointments. They will set up business and financial planning for our customers. We will work with Prudential. Prudential will provide us with different insurance practices because we have a security level 7, series 7 license. We're going to be able to sell 401ks and different retirement plans for businesses. We will sit with the mom and pop shop and we will help them to secure their future through strategic financial planning. I have on board 2 CPAs that work with me and have been with me for the last 20 years. These CPAs come to the table to help the business from opening the business to running their financial statements to setting up their budget in order for them to be able to operate their business with success. I also have on my team 2 experts that deal with marketing. These marketing experts have been in the business for 20 years, and they will come into the business and help us to target the best businesses in the market and how to best position ourselves on the internet and on different marketing platforms. I hope you can give me the $30,000 because I feel that I'm prepared. I will put $20,000 of my own money. With this $30,000 seed money, it will help me to get started. Here's my location. I've done my primary research. According to my primary research, 86% of those that I researched said that they would be interested in my type of business. When I did a survey of the surrounding areas, there is no consulting business within 20 miles of where I'm putting my location. Where I'm putting my location has a population of about 17,000 people. From them 17,000 people, after I did my research, about 44 to 45% do not have any type of retirement account and said that they would welcome a financial institution as mine that can help them secure their future. See, you got to go to your presentation knowing what you're presenting and with a confidence that you're speaking with assurance that nobody knows the business better than you. Nobody, you need the money, but you're not looking to blow the money. You're looking to expand the business. You're looking to level up. You're looking to succeed. When you do business, the number one thing, and I can't stress it enough, ethics, ethics, ethics. Don't ever compromise your ethics nor cut corners. It will ruin your business. There's some people you're going to have to say no to. There's some people that are going to try to get you to cut corners. Don't cut corners. It'll take you a lifetime to build your reputation. It takes 5 to 10 minutes, a wrong decision, to ruin your business. My wife and I have always put that in practice in business. There's been clients that have sent us extra money. We've sent it back. They didn't even know they sent us extra money. And I'm like, no, you already paid me for the tax return, sir. You done paid me double. Here's your money back. Because what if they're testing me? I'm supposed to be their financial guy. I'm supposed to be their confidant. I'm supposed to be their friend. And they pay me twice and I stay quiet. So any business owner, it'll take you a lifetime to build your ethics. It could take you 5 minutes to ruin it.
Right.
Don't ever ruin it. Do what you promise to do. Do what you say you're going to do. If you cannot do what you promise to do, don't promise. Because some people to make a sale overpromise. And I learned a long time. I used to do that. When I started in business, I was building computers. And because I wanted to do a sale, I was young and I wanted to make a sale. I was promising all kinds of stuff, lifetime setup and programming. And I was basically telling you, I'll come to your house and turn it on. If you don't know how to turn it on, just buy it from me. And then when we started growing, people did call. Hi, my monitor is not working. Well, they had it unplugged. But now I was driving to people's houses because that's what I promised. Now it was costing me money on the computer I sold them
Uh-huh.
for simple things that I said, any problem, there's not a problem. That's an ignorant problem. Call me. I will come and make sure that you're always 100%. I would drive to people's house, spend my gas, spend my money to turn their monitor on or to plug it in because I gave my word. I was losing money. So now I tell people, don't overpromise, just be honest, and don't put expectations up here. Put expectations based on your capabilities.
Capability, yeah.
Based on your capabilities. Don't overpromise and then under-deliver.
If we, is it over promising, not over promising, but sometimes people order online and then we tell them, oh, you should have just called us because we can just bring it to you and we give you your money back for the shipping charges. Because on our online service, the shipping automatically, it calculates itself. So I think we've been maybe not losing customers, but losing money because we carry things all over the place because we're trying to be nice. I think we're trying to help people out.
Nice is gonna cost you money. To me, if they went online, they pay for shipping, ship it. Your time, what is your time worth? What is your gas worth?
That's right, yeah.
So now you're driving all over New Jersey,
Uh-huh.
wasting your gas, wasting your time. So you make $10 on a pound cake.
Uh-huh.
By the time you calculate the gas, as expensive as it is now, delivering, you just took your $10 and reduced it to $2.
Exactly.
Don't do that.
Okay.
Don't do that. What I tell people is, look, if they knew, like to me, it's if I order something from Amazon and at the end it says shipping $10 and I agree to the $10, I'm not expecting for Amazon to call me and tell me, hey, Ed, I could bring it to you and I'm going to give you $10 back. Amazon, first of all, is never going to do that. It's never going to do that. And if I've already paid the $10 for shipping, I'm aware that I agree to pay the shipping cost.
Right.
Yeah.
So it's something being nice and something not being business savvy. So you have to make sure that you got to make sure that if it's there and you're being honest and you're saying shipping is X amount of dollars, ship it. Your time and driving around is too valuable.
Exactly.
For you to be saying, I'll give it back to you, I'll deliver, because you shouldn't give the shipping back. I wouldn't refund the shipping because, okay, UPS is not shipping it, but you are. So it's costing you money to drive it.
Exactly.
So don't undercut yourself.
Stupid.
Yeah, be wise, be wise. In business, it's business and you gotta make money. And that's why I want you to do a projection because the projection is gonna help you to analyze and it's gonna help you to make these sorts of decisions. Maybe you discover I'm charging too cheap. Maybe I gotta reduce the quantity to make more money. It's okay. Prices are changing, but don't never devalue your product or your services. It's what I offer. If they don't wanna do business with you, don't do business with them. Just because you wanna make a sale, don't devalue your product.
Yeah, right.
You know, you gotta keep your level of expertise. I'm the expert, I'm providing a good service. I'm not gonna undercut myself. And the good people will come and some will say no, and some will say yes. But don't undervalue yourself just to do a sale. All right, so class, that's all I have. For those that are online, thank you for connecting. Thank you for being with me these last 4 weeks. If you didn't get enough and you want to get it in Spanish, I'm going to teach this class again 100% in Spanish on Thursday, 6 to 8. So if you want to get some more, you can plug in if you speak the Spanish language. But other than that, that's all I have for today. Thank you, class. God bless you. And I'll see you guys whenever you guys contact me on Zoom. That's all I have. Thank you.